Hello, my friends. Today is February 14th, and this is Markets Weekly. So this past week was a very volatile week in markets. As we've been discussing over the recent weeks, it really seemed to me that the market was losing momentum. Now, this past week, we saw the S&P 500 lose the 50-day moving average. On Friday, it came very close to losing the 100-day moving average as well. That kind of reminded me of a wise person who traded through the dot-com boom and bust, that during the dot-com, a lot of people went broke selling it, and a few years later, even more people went broke buying it. Now, I'm getting the sense, just a guess, that we probably have to test the 200-day moving average around 6,500 because trend doesn't look that great. This past week, we got a lot of tier 1 data. We got the non-farm payrolls print, we got retail sales, and we also got CPI. So first, let's talk about the data. And secondly, I started using cloud AI last week. Of course, we saw huge amounts of selling in the SaaS stocks and even some wealth management stocks, all the stocks that were perceived to be disrupted by AI. So I had to try the latest AI myself, and I'm beginning to think that AI is going to be very good for bonds. All right, starting with the data. So we got three huge prints last week. First of all, of course, the non-farm payrolls print. The January print was delayed until last week, and it was much better than expected. However, it also came with the annual benchmark revisions, and the benchmark revisions basically erased 1 million jobs created last year. So as we've been discussing before, the market really doesn't care about revisions. It only cares about the monthly prints. If the monthly prints last year were accurate, we would have had 0 or negative monthly prints, and that would have been very upsetting to the markets. But now that a year later, we revise them all away, the market really doesn't care. What it does care about, though, is that it seems like the job market is improving. So the January report was better than expected, and maybe it will be revised away a year from now. But at the moment, it's better than expected, and the market is going to perceive that to be good, and that the economy is less likely to go into a recession. But it also, of course, reduces the odds of Fed rate cuts. Now, we also got the retail sales and CPI last week. But before we talk about that, we have to mention a little bit about seasonal adjustments. So throughout the year, data is uneven because of seasonal effects. For example, people tend to do a lot of shopping in November and December. That's a big holiday season. So retail sales there are going to be a lot more. And in January, people tend to reset their prices. For example, if you're a company and you want to raise or lower prices on your products or services, you tend to do that in the beginning of the year. So there is some seasonality to how this data is computed. And to make data more comparable month to month, economists or statisticians tend to do these seasonal adjustments. So keep that in mind when thinking about the data. So for retail sales, the data was much lower than expected. They were basically flat month to month. And some people think that could be due to aggressive seasonal adjustments, which are difficult to make because, of course, the economy is changing, behavior changes, and so sometimes seasonal adjustments can be overdone or underdone. Now, moving on to CPI data, CPI was better than expected, but still, at the end of the day, it's still about 2.5% above the Fed's target. One thing to note, of course, is that companies do raise their prices in January, and so these seasonal adjustments make the January print less accurate than other prints as well. So all in all, though, this is data that is kind of positive, right? You have better than expected job growth, and you have inflation that's coming down. But of course, the market didn't seem to really care about this. They were really more cared about what seemed to be happening in the AI world, and that is the AI is cannibalizing current companies. So that brings us to our next topic. So I've talked about AI before. I started trying to use AI to help with my workload. And in the beginning, it was very disappointing. So I asked the AI to do basic things like, tell me when Fed officials are speaking, and it really couldn't do that. It was amazing to me that I asked it to go on the Federal Reserve's website to look up who's going to be speaking this week, and it could not do that. So that was very disappointing. But last week, we had the release of the latest cloud model, and we also had carnage in a lot of software as a service companies. The market, or at least people who follow this, was thinking that the latest AI is really going to be very destructive to the value of these companies. Maybe there's more competition. Maybe consumers are going to move to bespoke AI created, vibe coded platforms and so forth. We even saw some wealth management companies like Schwab sell off aggressively because maybe AI can provide tax efficient strategies in place of wealth advisors. So again, I had to try this for myself. So I signed up for the Cloud Max plan. So that's like $100 a month and got to use it. So what did I use it for? Well, as you guys know, I am writing the second edition to my book, Central Banking 101. The last one was 5 years ago. So between then and now, a lot of things happened. So I've updated all the data, added a whole bunch of new sections about, the Silicon Valley bust, Silicon Valley Bank bust, treasury buybacks, QT, all that stuff. So I basically updated everything, and I felt like I was basically done with the manuscript. So usually what I would do is I would hire an editor, a freelancer, and pay him a few $1,000s to go through this. And I would also hire some artists to make a new book cover for a few $100s. And these are people that I would source through Upwork.com, basically sites that post for freelancers. But this time, I decided I would give AI a try since that's what all the cool kids are doing right now. So I uploaded everything into Cloud and asked him to kind of, be my editor and proofread it. He said that it would take 6 hours. And so I waited for 6 hours. And what I got back was, I guess he gave me like a few suggestions, updated some data points and stuff like that, some very general stuff. I thought it was actually pretty, just meh, not that special. But, maybe it's my fault. Maybe I'm not prompting Cloud correctly. So this is what I did. I prompted him in a more precise way. I said, could you look at the reviews that are posted on Goodreads, on Amazon? And there are a lot of reviews. And can you, bearing that feedback in mind, can you go through the manuscript and can you give me some suggestions? And also just, broad suggestions as to where I could do better and so forth like that. So this time it only took, a few minutes. Maybe it's already in his memory or something like that. And he came back with actually something that was pretty helpful. Gave me a list of suggestions. Gave me a separate Word document detailing this. And, looking through it, some of them were not that great, stylistic, of course. Some of them were pretty good. One of them, for example, was that in your reviews, people suggest you having a glossary so that they can look up these acronyms, QT, FOMC, stuff like that. That was a pretty good suggestion. And some of them also suggested that, hey, maybe you could have summary chapter bullet points, kind of like a textbook. At the end of the textbook, you kind of give you a summary as to what you should have learned from this chapter. I thought that was a pretty good suggestion as well. And so I asked Claude, could you do that for me? And just like that, it created wonderfully made glossary, wonderfully made bullet points. And I thought that was pretty cool. I'm guessing that it could do more to help me with my manuscript, but I'm probably not prompting it well enough. It did tell me, though, that it was very good and well written. And so I think it's just part of its job, like any employee. When I went to ask it about helping me create a new cover for my updated version, I gave it my prior cover and, gave it some ideas. And it immediately, basically like Grok, gave me a number of ideas and ways to pursue. And that's actually exactly what a real human cover designer would have done. He would have given me a few design choices, and then I would have, decided which one to go and how to advance it. So I'm probably just going to use Cloud as an editor. I think it's really good enough. And honestly, I don't know it's hard for me to know if the human editors that I hire are good or not until after the fact. But for the artistic stuff, I think I'm still going to hire a real designer. I think having that human artistic touch is something that I'm not really sure that Cloud can fully do right now. The covers he's shown me are very good. But I guess I'm just not confident enough in my own judgment and prefer someone who a proper artist to do that. But that immediately got me thinking as to just what the implications of this are. So just, first principle, first level thinking. So I would have spent a few $1,000s on a freelance editor, and now I'm not going to do that. I'm going to use Cloud instead, Cloud, which costs $100 a month, which of course does not cover its operating costs, right? Cloud, Anthropic continues to lose money. So first impact, of course, is that I get fast service and better service, like goods and services are produced Buy Cloud AI, and immediately everything is my readers supposedly benefit, and I benefit as well. However, this is not really going to show up in GDP data because I'm just paying Cloud $100 a month, and Cloud is losing money. And it's kind of like how people who use AI and create all sorts of funny videos and memes. These are actually goods and services that are produced, but of course you don't really pay for them, and so people don't pay to see them, and so you don't really impact GDP. However, this editor that I would have hired, he's not going to be hired. So that is going to increase unemployment and actually reduce GDP because he would have produced goods and services that I paid for, but he's not. And so maybe someone else hires him, maybe not. My guess is just on a macro scale, on the margins, people like him are just not going to be working. And so obviously, slight upward pressure on unemployment, improvement in goods and services, the quality of it, but improvements that don't show up in GDP. So, that's kind of an interesting combination, but honestly kind of common when we think about technology over the past few decades, right? So your iPhone, for example, is much better than it was 10 years ago. It doesn't really cost that much more. So when you think about paying for stuff, it doesn't really show up in GDP, but the quality of the services is better. And I think this seems to be an extension of that. Now, thinking more broadly, let's say, how does this impact businesses and so forth? I give you an example of what I'm doing with my, the second edition of the book, but you can generalize this, for example, to writing a newsletter, right? So if I use AI to help me with my workload, and sometimes I do, for example, the Fed released a lot of confidential documents, I believe in 2020, and they do that on a 5-year lag. And so I had AI look through it to see if there was anything interesting. Now, otherwise, I either would not have done this or would have taken me a long time because it's literally hundreds and hundreds of pages to look through. And the AI was helpful in looking through that. So that helps me in that it makes me a little bit smarter and more able to provide a slightly better product to people who subscribe. However, I'm not able to charge more for that, and it does not increase the amount of subscribers. So it's an improvement, but it really doesn't show up in GDP. So I think that's probably going to be pretty common for a lot of industries. Just thinking back through the industries that I've been involved in the past. For example, my first job was at a law firm. And at a law firm, a lot of the work that lawyers do, it depends. But broadly speaking, if you're a junior associate in litigation, you would be spending a lot of time researching legal cases on Westlaw, LexisNexis, or something like that. AI can definitely do that very well and much better than any associate can. If you are someone on the transactional side, you would be editing contracts, for example. Honestly, it would be basically getting a contract that the firm did for like JP Morgan and then updating the terms for a contract for a Morgan Stanley deal, find and replace, literally find and replace JP Morgan, Morgan Stanley, updating the numbers, 100 million to 200 million, and then conforming changes in case the law change, stuff like that. The AI can do that really well as well. So from a junior associate perspective, you're not going to need as many of them. From a partner, senior associate perspective, it's going to make you a lot more efficient. So at the end of the day, though, what would happen, it seems, again, first thing that will happen is that it's going to save you time. And one thing you can do with your time is to do other productive things, or you can simply shrink your time. On an individual basis, it's me watching more TV. On a firm level basis, it's having smaller headcount, which anecdotally we hear firms are doing. Now, from a productivity standpoint, the firm is not going to be charging less because it's using AI more rather than junior associates. Okay, so law firm is a little bit different because they're billed by the hour, but generally a corporation, it's not going to adjust its pricing revenue structure immediately. So it's probably going to be reaping those efficiency gains through higher profits and higher profits to lower headcount. But when you think to the second stage of this, though, at the end of the day, there's not going to be more aggregate demand, right? It's kind of like going to my newsletter example. If I'm able to produce this more efficiently, It doesn't necessarily mean that I'm going to have more subscribers. And so from a law firm or any other services business, even though you are more efficient, you need fewer people, can have higher profits. It doesn't necessarily mean that you expand your customers, doesn't mean that you can charge higher prices. So first up, it's going to be GDP neutral because you continue to produce the same amount of services and you have higher profits. But then again, you're kind of cannibalizing what you would have what the worker you laid off would have produced. But afterwards, though, unless you have greater demand so that you actually produce more goods and services, you're not going to increase your aggregate GDP. And if you're firing workers, you're going to reduce your aggregate demand eventually in the economy. So it seems like this would ultimately be on the second step, just kind of demand negative. It would actually shrink GDP because it doesn't actually increase the aggregate demand of the economy because you're firing more people who in theory would have been sources of demand. At the end of the day, everyone will have higher quality goods, higher quality services, right? You will be able to access like some of the smartest, the smartest advice, smartest information you could with a click of a button, either through AI directly or through some kind of professional who is employing AI. So your quality of life will be higher, but I don't think it's going to show up in GDP for the reasons I cited earlier. So that's kind of an interesting conundrum. And the implications for markets is that, well, of course, we already see this creative destruction happening right now. Companies, first, again, are going to have higher profit margins, so that's good. But then some companies will be completely superseded, and so that's bad for them. Eventually, though, you're going to have competition, and those higher profit margins will be competed lower. AI does level the playing field a little bit in that smaller companies will have access to tools and resources that they would not have had access to before. So if you have higher unemployment, and maybe massive disruption in the financial markets as we sort through all this creative destruction, who's winning, who's losing, and even the winners eventually have lower profits, that seems like it's going to be stock market negative. So when you put that together, I'm beginning to think that the ultimate AI trade is going to be bonds. You're going to have a lot more rate cuts, higher unemployment, lower stock prices, more financial market volatility. So I'm getting the sense that maybe that is going to actually be the ultimate good AI trade. But we'll see. In any case, those are my thoughts right now. Thanks so much for tuning in, and I'll talk to you next week.